Hello everyone, welcome to the market opening bell on Monday, June 16th. Last week, Hong Kong stocks experienced an initial rise followed by a decline. The Hang Seng Index briefly crossed 24,000 points, reaching a high of 24,439 on Wednesday, the highest since March 20th. This year. However, it fell on Thursday and Friday, closing at 23,893 on Friday, still managing a 100-point or 0.4% gain week on week, marking its second consecutive weekly increase. The X-share index closed at 8,655, up 0.3% week on week, also rising for the second straight week, while the Hang Seng Tech Index closed at 5,240, down 0.9% week on week. Southbound funds net purchased 189 million Hong Kong dollars of Hong Kong stocks on Friday, with significant net buys in Meituan at 1.218 billion Hong Kong dollars and China Construction Bank at 405 million. Conversely, there were notable net sales in Alibaba at 3.314 billion dollars, Tencent at $2.064 billion, Sinuk at 919 million, Kuaishou at 817 million, Xiaomi at 764 million, Bank of China at 405 million, Innovent Biologics at 394 million, and Beijing at 236 million. Southbound funds have been net selling Tencent for 11 consecutive days, totaling 14.096 billion Hong Kong dollars. Alibaba for 5 days at 7.447 billion Hong Kong dollars. Net buying China Construction Bank for 3 days, amounting to 1.51 billion. This week, markets will closely monitor progress and details from US-China trade talks on reciprocal tariffs, alongside developments in Middle East geopolitics. From a technical perspective, the Hang Seng Index hit a low of 23,775 on Friday, closing at 23,893, filling the upward gap from June 9th between 23,951 and 23,958. The 10-day moving average at 23,866 held for now, but this week is likely to face another test. If the 10-day line breaks, the index could slide to the 20-day line at 23,700, potentially filling the June 5th upward gap between 23,717 and 23,732. In mainland China, the Shanghai Composite Index briefly reclaimed 3,400 but closed at 3,377 on Friday, down 8 points or 0.2% week on week. The Shenzhen Component Index closed at 10,122, down 0.7% week on week. The renminbi central parity rate rose for 4 consecutive days, breaking the 7.18 mark against the US dollar on Friday to 7.1772, hitting a 2.5-month high. The People's Bank of China reported that renminbi loans grew by 10.68 trillion yuan in the first 5 months, with 10.06 trillion yuan added in the first 4 months. May saw 620 billion yuan in new loans, up 280 billion yuan in April, but below the expected 850 billion yuan. May's social financing scale increased by 2.2 trillion yuan, 224.7 billion yuan more than last year, with a cumulative total of 18.63 trillion yuan for the first 5 months, up 3.83 trillion yuan year on year. M2 money supply grew 7.9% in May, down 0.1 percentage points from April, slightly missing the expected 8.1%. Today, China will release key economic data, including May retail sales, forecasted to rise 4.9% compared to 5.1% previously. January to May fixed asset investment expected to grow 4% as in the first 4 months. May industrial production projected to increase 6% versus 6.1% prior, and the May urban unemployment rate to hold at 5.1%. Escalating Middle East tensions led to over 1% declines in major U.S. indexes on Friday. The Dow closed at 42,197, down 769 points or 1.8%. The S&P 500 at 5,976, down 68 points or 1.1%, and the Nasdaq at 19,406, down 255 points or 1.3%. For the week, the Dow fell 1.3%, the Nasdaq 0.6%, and the S&P 500 0.4%. The Nasdaq Golden Dragon China Index dropped 203 points or 2.7%, closing at 7,233. Major tech stocks weakened, with Nvidia down 2.1%, Meta and Apple down over 1%. Tesla surged over 4% intraday on U.S. plans to simplify autonomous vehicle exemptions, closing up 1.9%. Concerns over oil supply disruptions pushed oil prices up over 7%, boosting energy stocks but weighing on airlines. ExxonMobil rose 2.2%, Chevron gained less than 1%, while Delta Airlines fell nearly 4%, and United and American Airlines dropped over 4%. On the economic front, June's preliminary University of Michigan Consumer Confidence Index jumped from 52.2 in May to 60.5, far exceeding expectations of 53.6. Oil prices surged due to Middle East tensions. WTI July crude futures hit 77.62 US dollars, nearing the June 16, 2022 peak of 78.48 US dollars, closing up $4.94 or 7.26% at 72.98 per barrel, with a weekly gain of nearly 13.01%. Brent August futures reached $78.5, closing up $4.87 or 7.02% at $74.23 per barrel, up over 11.67% weekly. However, sustaining these levels is unlikely unless Iran blocks the Strait of Hormuz. OPEC Plus increased output by 180,000 barrels per day in May, with Saudi Arabia and Libya also raising production. OPEC Secretary General Al Ghaz stated no supply or market dynamics warrant unnecessary measures, and the IEA is prepared to tap emergency reserves if needed. Additionally, U.S. tariff policies may dampen global growth, reducing oil demand. Gold as a safe haven asset saw spot prices rise 1.3% on Friday to 3,428 US dollars per ounce, with a weekly gain of about 4%. Beyond safe haven demand, continued global central bank gold purchases and demand for dollar alternatives will support prices, with potential to test 3,500 US dollars in the future. Our stock pick today is CDB Leasing, stock code 1606. CDB Leasing primarily engages in aircraft leasing, infrastructure leasing, ship leasing, commercial vehicle and construction machinery leasing, and other leasing business. In aircraft leasing, as of December 31st, 2024, the group owns 521 aircraft, consisting of 311 owned aircraft and 210 ordered aircraft, with a global customer network covering 85 lessees in 41 countries and regions. Among the owned aircraft, 307 are used for operating leases and 4 for finance leases. By aircraft value, as of December 31st, 2024, the total net book value of the group's owned aircraft is US dollar 12.583 billion, with narrow-body aircraft accounting for 78%, wide-body aircraft 18%, and freighters and regional aircraft 4%. The weighted average age of owned aircraft used for operating leases is 5.4 years, with a remaining weighted average lease term of 7.3 years. As of December 31st, 2024, the group has committed to directly ordering 197 narrow-body aircraft from manufacturers, including 85 from Boeing and 112 from Airbus, scheduled for delivery between 2025 and 2032. In addition to these committed orders, the group holds non-binding purchase rights for 70 aircraft from the Commercial Aircraft Corporation of China, including 20 C909 and 50 C919 aircraft. In regional development leasing, the group focuses on key areas such as the Beijing-Tianjin-Hebei region, Yangtze River Delta, Guangdong, Hong Kong, Macau Greater Bay Area, Yangtze River Economic Belt, and Yellow River Basin, strongly supporting key sectors and weak links. By the end of 2024, the group provided regional development leasing services to 26 provinces, autonomous regions, and municipalities nationwide. In ship leasing, as of December 31st, 2024, the group operates 253 vessels, including 36 under finance leases and 217 under operating leases. By vessel type, there are 173 bulk carriers, 47 oil tankers, 13 container ships, 18 LNG carriers, and 2 passenger cruise ships. The average age of operating vessels is 6.9 years, with bulk carriers at 6.4 years, container ships at 8.3 years, oil tankers at 6.6 years, LNG carriers at 10.3 years, and passenger cruise ships at 15.5 years. The relatively young fleet age structure provides strong competitive advantages in operational efficiency, safety, and environmental performance. Additionally, the group has 8 vessels under construction, including 6 bulk carriers and 2 oil tankers. In inclusive finance, the group continues to expand the potential of vehicle leasing, capitalizing on key vehicle replacement cycles of partner clients and deepening its presence in mobility and urban logistics. In construction and agricultural machinery leasing, the group responds to national initiatives by launching agricultural financing products for key agricultural regions, providing financial support for farmers to purchase agricultural equipment, further expanding the depth and breadth of financial services. The group also continues to focus on green energy, covering wind power, photovoltaic, hydropower, and energy storage. Meanwhile, it targets technology-driven enterprises and high-end manufacturing, increasing investments in areas such as computing power, power batteries, and integrated circuits. The group's performance remains stable. In 2024, it achieved revenue of 25.435 billion yuan, a year-on-year increase of 10.6%. Profit attributable to shareholders was 4.502 billion yuan, up 8.5%, and the non-performing asset ratio was 0.56%, down 0.04 percentage points from the previous year. The full-year dividend was 8.905 cents per share, with a current dividend yield of nearly 7%. Recommended buy price is 1.38 Hong Kong dollars. Target price is $1.54, and stop loss is $1.3. I do not hold the above stock.